Insurance trust. An insurance trust is an irrevocable trust set up with a life insurance policy as the asset, allowing the grantor of the policy to exempt assets away from their taxable estate. Once the life insurance policy is placed in the trust, the insured person no longer owns the policy, which will be managed by the trustee on behalf of the policy beneficiaries when the insured person dies. How an insurance trust works. An irrevocable life insurance trust (ILIT) is a trust within which a life insurance policy is placed. Because it is irrevocable, it cannot be rescinded, amended, or modified after the fact. This means that once the grantor establishes the life insurance policy in the ILIT, they cannot change the term of the policy or reclaim it. As an alternative to naming an individual beneficiary to receive the death benefit of an insurance policy when the insured passes away, ILIT provides several legal and financial advantages to one heirs, such as more favorable tax treatment, asset protection, and assurances that the money received from the death benefit can only be used in a manner in line with the deceased's wishes. ILIT are also used to minimize the estate tax due for wealthier individuals. This is done by making the trust the owner of the policy and the grantor the insured. To avoid the incidence of ownership, the trust grantor can thus have the trust itself apply for the insurance policy and be the owner from inception. For the life insurance policy to be excluded from one's personal estate, there must have been no incident ownership within the 3 years prior to the insured death, meaning a policy must be transferred at least 3 years prior to their death. To avoid this, the trust can apply as a legal entity for the policy directly. Steps to take to establish an ILIT. Steps that are ideal when establishing an ILIT. ILIT is executed prior to policy application and any premium payment. Grantor transfer fund or gift to ILIT for premium payments. ILIT trustee notifies beneficiaries of cremate withdrawal right each time gifts are transferred to the ILIT. ILIT trustee applies for policy on grantor's life as owner and beneficiary of the insurance policy. In the U.S., proper ownership of life insurance is important if the insurance proceeds are to escape federal estate taxation. If the policy is owned by the insured, the proceeds will be subject to estate tax. To avoid estate taxation, some insured name a child, spouse, or another beneficiary as the owner of the policy. Beneficiaries do not have the power to make changes to an ILIT, but they may have current withdrawal rights or powers under the cremate powers. Benefits of an ILIT. If you are the insured and also own the life insurance personally, the death benefit will be considered part of the value of your overall estate when you pass away. This could potentially expose your heirs to estate tax upon your death. When put into an ILIT, however, the trust becomes the owner of the policy. The proceeds from the death benefit, therefore, are no longer included in the insured gross estate and will not contribute toward the value of the estate, thus minimizing potential estate tax exposure. ILIT can also be structured to avoid gift taxes made to one's beneficiaries. In this case, premiums paid to the policy inside of the ILIT can be construed as a gift, but the gift tax can be avoided if a cremate letter is drafted stipulating that the gift is being made to the trust. Another benefit of an ILIT is that the trust can establish rules by which beneficiaries must adhere when the death benefit is paid. The trust document can stipulate only a certain amount of money per year be withdrawn, for example, or that the proceeds can only be used for certain things like a college education until the beneficiary reaches, say, 25 years of age. Such guideline can also become useful in the case of second or third marriage to ensure that only the insured children have a legal claim to the funds. Thank you.